Welcome again, everyone, to another video, financial analysis video. I'm Moeed Amin, and here with Ted Wayman. Great company to be looking at today. Another first for us in terms of this video cast, at least. We're looking at Kodal Minerals today. They are an exploration and development company specifically around lithium and gold. So they are a UK-based business, but they have mines and areas that they're exploring, mostly in southern Mali and the surrounding countries, which is based in West Africa. So an interesting business to look at, some very different things in the financial statements, actually very similar to another company that we looked at called Powerhouse Energy in terms of that technicality. We'll show you that in a moment, so stick around for that. But before doing so, we want to thank one of our viewers, well, actually a couple of our viewers. So Rajiv and Nav, who both requested for us to look at this company for them. Your request has been delivered, so I hope you enjoy this video. Ted, what did we find out about this company? Quite interesting stuff, actually.
Absolutely, Moeed. So we are going to jump into the financials, and what we are going to do when we jump into the financials is make a caveat that this is fundamental analysis. This is looking at the financial statements only. So I have had comments that you cannot value a mining company by looking at the financial statements. 100%, especially if it's early stage mining company. So all we're saying here is that if you are going to look at a company, if you are going to look at an investment, you want to do your fundamental analysis. One of the things you're going to look at is the annual report and accounts, and that's going to give you a lot of what's going on in terms of the strategic report, the chairman's statement, the operational statement, the report of the directors. It's going to tell you all about the mines that they're in, where they are, what they're doing, where they're digging, what they found, what they haven't found. Look at this, lots of lovely pictures, etc., etc. And this is part of your research. I'm not going to be looking at any of this. I'm not going to go through all of this in detail. You can read it yourself. My role is just to kind of add to that by giving you some information about the numbers and the finances of the business. So we start with the income statement, and the income statement is on page 44. So we've got to scroll all the way down through this information, which you as the fundamental analyst investor are going to read in your own time. And we come to the income statement. Here we are. So let's kick off. First thing we notice about this company, they are making no sales. They made no sales last year. They made no sales this year. That tells me that they are still in the early stages of exploring. They're having a look around. So typically what will happen is that they'll get the geologists in who will say, we think there's some lithium here, and they'll kind of use all their seismic kind of, radars and kind of, whatever they do, the geologists do, looking at rocks and so on. And then they'll do sort of send some boreholes down, and they'll pick up a little bit of, and they say, oh, look, there is some lithium in there. We think that we found some and that there's a big enough seam that we can actually then go to the next stage and start to extract. And once they extract it, then they've got to sell it. And the selling is pretty easy because it's a commodity, so there's a market price out there. But they haven't got to that stage because revenue is zero. So I don't know when the revenue is going to start to come in, and you can read through the report and make your own assessment of that. Meanwhile, they are running the business. This is actually in pounds, you'll notice. So we're not in thousands or millions of pounds, just in pounds. So they're spending about £600,000 on actually running the business. Okay. Now, very important we understand that when we talk about running the business, this is things like finance, HR, board of directors, travel, subsistence, and all those kind of operational expenses that any typical business is going to incur. It does not include the costs of looking for the lithium. Okay, and I'll come on to those costs in a minute. So what we see from looking at here, the income statement, is that they are making a loss. Basically, the loss they're making is the cost of the is the cost they're incurring. You'll notice here that they make a distinction between the admin expenses and share-based payments. We can look at note 5 if we want to know a little bit more about share-based payments. That may be to the staff, incentivizing them to stay with the company and to help find this this sort of mythical lithium that they're looking for, or it may be to some of their suppliers. So they're looking at their suppliers, their contractors, bringing them to their supply chain, giving them a vested interest in helping them to find this lithium and to extract it, and that's a fairly substantial amount there. Don't forget, if a company is making share-based payments, you as a shareholder are being diluted. Okay, I'm not saying that that's a bad thing, it's just something to be aware of. So really, their loss for the year, we are really interested in this line here. It's about £600,000 to £700,000. Let's keep on going. So just to make a note that this bit down here, this is what we call unrealized or other comprehensive income. Often will sit in a separate statement. This is really saying, look, you've made a currency gain or a currency loss. It's an unrealized gain. So I don't know, you buy a house in America for $1 million today, it's still worth $1 million. The value to you has gone up or down because of the currency fluctuation, but you haven't made a profit or a loss until you sell it. So it's unrecognized until you sell it. So we don't really have to worry too much about that section. So let's go and have a look at their balance sheet. So this is really the important part of the balance sheet. So the big number here. So here is their non-current assets this year, and their non-current assets is the things that we need to run the business, and easily the biggest number, 6 million intangible assets. Going to tells us what that is. I can tell you now, this is exploration. What's known as E&E, exploration and extraction costs. So this is really about the exploration costs, looking around, and what they're saying is that we've spent £8.5 million looking for lithium, and therefore we the company is we're that much closer with that much more information, and therefore this is an intangible asset. Now, you know as well as I do, Moeed, that if they don't find any lithium, that they're not going to put that on eBay and sell it. It's basically worthless. Okay, so this is just a sort of a form of capitalizing the costs, and you'll notice at the end of last year that was about 7 million. So it's gone from 7 million to 8.6 million, which basically is an increase of 1.6 million pounds. So in addition to the 600,000 they're spending running the company, they're spending another 1.7 million pounds looking for this lithium and capitalizing those costs. And that's really the costs of the business. Okay, let's look at the current assets. So the current assets are down here, and the big difference we notice here, we'll just put it in a different color so we can point it out, is cash. The cash has gone from 1.4 million pounds to 33,000. Now, it doesn't take a rocket scientist, Moeed, to work out that if you are spending 600,000 running your business and 1.7 million looking for lithium, which is about 2.3 million in total, and you've only got 33,000 pounds in the bank, you're gonna run out of cash. Okay, it shouldn't be a problem for these guys, because what are they going to do? They're going to go back to the market, they're going to issue some more shares, they're going to say, look, we've got a really good story, we're very nearly there, we just need a little bit more money. So what they're not doing is they're not raising 50 million and then finding that they don't need all of that 50 million. What they're doing is effectively they're raising the money as they need it, and as they get closer to the story, as it becomes more compelling, hopefully the share price has gone up, hopefully they don't have to sell so many shares, hopefully existing shareholders don't get diluted so much, and that's the benefit to the early investors. Of course, if they don't find any lithium, then the whole thing goes to zero. They often say that the definition of a mine is a hole in the ground with a liar on top, but I'm sure that's not the case here. Trade and other payables, in a traditional sense, if I was comparing the current assets, which are things which we own, which are either cash or going to become cash soon, and I was going to compare them with my trade and other payables, I would be very, very, very nervous by that ratio, because if you've got 53,000 in the bank or coming in as soon and you owe 660,000, you're basically bust. Okay, so these guys are really dependent on their ability to go back to the market and to continue to raise shares. And I'm sure that if we look in the news or look in the kind of the latest reports, and we can actually do that, I've got their quarter one, we would actually be able to see them raising additional money. Interesting, they've got these other receivables. It doesn't make sense what they'd have in other receivables. Don't forget they're not trading. So if they're not trading, there shouldn't be any, there certainly won't be any trade receivables. They've got a little bit of other receivables, only 20,000, not something I'm going to lose a lot of sleep over. Down the bottom, here's the equity. So we see from the equity, the share capital, the share premium. So we can see that there's been a difference from last year through to this year. It's not a massive amount, but they are raising additional funds. So they have been raising funds during the year, and even so, they finished the year with less cash than they started with, for example. There's the share-based payment reserves. So they are still, making those, they're issuing shares effectively. And here is the loss that they are running at, and that loss is basically the a reflection of the investment in the exploration. We're going to have a quick look at that exploration. I think it's worth just sort of checking that. So I think it was note 5 we were looking at, and I'll just bounce down to note 5 and show you that. When I say note 5, I obviously mean note 7, and here it is, exploration and evaluation, what's known as E&E, and here we can see, the costs that are involved. So the additions during the year, the 1.6 million, this is basically what they are spending on spending during the year with geologists and people with kind of test tubes and drilling and test pipes and all that kind of stuff, etc., etc., etc. So let's go and have a look at their cash flow statement and see how that is performing, whether that kind of reflects what our understanding of the business. So here is the cash flow statement, and so we've got our loss. So first of all, we're taking our loss before tax, a little bit of change in working capital, and the operating loss is pretty similar. You'll notice the big difference is this share-based payments. Again, this is a way of paying for something, so it costs you that. It's in the profit and loss account, but it does not affect your cash flow because you are just offering shares in the business. Cash flow from investing activities, well, there is your exploration. Okay, so £3.4 million spent last year on exploration and evaluation activities, 1.6 million this year. And then how are they financing it? Well, last year they sold they raised 2.2 million by issuing shares. This year they raised another 690,000 by issuing shares. And what I will do is just pull up the quarterly report, which I downloaded as well. So here is the consolidated interim statement. So this is the 6 months ended 30th of September, kind of gives us a sort of the latest update as to what's going on. And once again, we can see that they are still investing. So they are still doing their exploration. Here it's a little bit down, you'll notice on previous periods, and they are also raising money. So here, quite interesting, they're starting to issue convertible loan notes. Now, I think this is quite an interesting sign. So typically, if you're a mining company, you're not going to get a loan. No self-respecting bank is going to lend money to somebody who says, I think there's gold in them far hills, and sets off with a shovel and a pick. It's too high risk. So these companies tend to be equity funded. What's interesting here is that you've now got people who are issuing convertible loan notes, and a convertible loan note will be effectively, I've lent you the money, but I can convert it into equity if I want to. So if you strike gold, or obviously in our case, lithium, if you strike lithium, then I'm going to turn it into equity and be a shareholder. But if you don't, I'm going to be a lender to the business. I'm going to be first in the queue. I may not get all of my money back, but I've got first dibs on all of your assets, and I may be able to sell some of, the geological research, etc., and recover some of that. So it's a way of de-risking that. So this is just a little bit of a warning sign to me from the investor's perspective that suggests, are they getting a little bit nervous? Are they getting some cold feet? Are they wanting to try and de-risk? Are they trying to sort of take it a little bit off the table? Now, the company won't say that. Of course, they won't. They'll say, no, we're going all guns. We're going to find that lithium next time. This time next year, Rodney, we'll be millionaires. That's the story from any mining company. But it's interesting looking at this investment by the most recent fundraising from the shareholders. So there are the financial statements. There's no dividends being paid, obviously, because they're not making any profit. So let's go back and look at the share price, how the share price has been performing. So here we go. So we can see that these guys listed back in 2000 and, well, early the sort of 2012, something like that. Pretty high a share price. It fell dramatically. So obviously came to market with a very good story, which didn't stack up. A little bit of bump in 2017 and really been bumping along ever since. Let's kind of, if we take out that early movement and look at the company in a little bit more detail, over the last few years, we see that there's a bit of a spike, and really this is all trading on sentiment. So what we'll see here is that they'll have come to the market that have said, oh look, we found something. Oh no, maybe we didn't. No, actually. Oh no, yeah, we have. No, we haven't. No, actually, no, forget about that. Or the whole will say, oh yes, we have. No, we haven't. It's a roller coaster ride. So this is not for the faint-hearted. If you're a day trader and you like volatility, then maybe this is an investment for you. If you are a widow and an orphan, that's a metaphorical term we use in investment management, then this is not for you. This is not your safe. But maybe this is your kind of peripheral. This is your, if you don't like cryptocurrencies, but you want a 10 bagger potentially, then you're paying, you're getting the opportunity to buy in at 32p to a company which may quite well go bust, but may alternatively actually start to deliver. In terms of the P ratio, there is no P ratio because there's no earnings. The market cap, 50 million pounds. Remember that the balance sheet is £8 million, and that £8 million is basically £8 million worth of exploration and evaluation. And don't forget that if the company does go bust, you don't get that. The lender to the company will immediately make a security on that asset and say that they're going to take the whole lot. So there you go, Moeed. There is our business in a nutshell. Is it something you want to invest in? Well, it depends on your appetite for risk, and how whether you can enjoy the ride without. I wouldn't bet the house on it. Let's put it like that.
Yep, totally agree. And another really interesting one. Not much more to add there, right? I mean, if you know the industry, anyone's watching this and knows the industry and they have something of value to add to this and they would like to share some of that insights, then do please leave your message and leave your thoughts in the comment section. Don't forget to like, share, subscribe. Interesting company. We haven't looked at mining companies, at least on this show. We have separately in other areas, but certainly on this show, this would be the first time. So what is everyone's thoughts? And look, if you have another company that you would like us to analyze for you, do leave a note in the comment section. But until the next video, thank you, everyone, and we'll see you soon. Thank you, Ted.